We used to joke that people would read the Wall Street Journal as if they were the only ones reading it. And then they would go and place their trades. First of all, by the time it's get printed in the Wall Street Journal, it's really old.
Hey, everybody. Welcome back to another episode of the Richer Geek Podcast. Today, we have Mark Hebner. He's the founder and CEO of Index Funds Advisors. He's on a mission to change the way the world invests by replacing speculation with education. And actually, the investing company ACOMS was inspired by his methodology. How you doing, bud?
Acorns, yeah.
Acorns.
Yeah. Acorns is an app that helps people kind of save and invest.
So we're going to get into, a little bit of what we think the stock market is and the traditional, what, advisors tell us to believe. So give us a little bit about your background and how you got started and where you're at now.
Sure. So I started this company 25 years ago on March 5th of 2024. It will be 25 years. So we've been planning our big celebration of that. And I started with the idea that most of my friends and relatives had been essentially gambling in the market and were not aware that a passively managed index fund actually does better on a risk-adjusted, cost-adjusted basis than people sort of gambling among different types of stocks. So you have to benchmark their performance. If they're buying large stocks, gambling in the S&P 500 stocks, then you compare that to the S&P 500. If they're buying technology stocks, you want to compare it to NASDAQ and different benchmarks out there that are available. And most people didn't really understand, and probably even today don't understand this concept of benchmarking their returns against an alternative investment, which would be these passively managed index-based funds. So anyway, so we started 25 years ago. We were really an internet-based investment advisory business with investment advisors on the phone and doing webcasts. Way back then in 1999, we were trying to do that with clients. We had all the tools, but most clients didn't. But after COVID, it works great now because everybody knows how to use Zoom. But anyway, we started basically with zero, and today we have $5 billion in assets under management as of the year end of 2023. So we've obtained about, 2,400 clients and help them manage their wealth in what we like to call the most optimized way. That's optimized between the risk they take and the return they expect to earn.
Now,
does that help you?
It does. Tell us a little bit of difference. You're speaking about index funds. What is an index fund compared to all the other stuff that you can do out there?
Sure. So the most famous of them is the S&P 500 fund. So there's 500 stocks, and when you invest in them, they put the most money of your investment in the largest company. They call it a market cap weighted index based on the market capitalization of a stock. Mm-hmm. So Apple, Microsoft are going to get the most amount of money of all of your investment. Maybe it's, I don't even know what it is today, 5-6%. Goes into those stocks, and then it goes down. And so the smallest company in the S&P 500 gets the least amount. Mm-hmm. But that's just one index. I think there's literally hundreds of thousands of indexes today if you look at all the different companies doing index creation. And there's even indexes created by academics. They call them research indexes. And among the most famous there are couple guys, Eugene Fama and Kenneth French. They're the Fama French indexes, and they slice up the market to value companies and growth companies and large companies, small companies, and they do that international, US, emerging markets. So there's all kinds of ways you can slice and dice markets. But I like to say an index fund is a set of rules of ownership that are held constant regardless of the market condition.
Mhm.
That last part is the hard part for people. They think, oh my gosh, it's 2008, 2009. I've got to change my investment strategy. Something went wrong with the market, what have you, and or whatever it might be, COVID, in March of 2020, market takes a big dump. People get scared, want to sell. But you don't want to do that. You want to basically bear the risk to capture the return. That's what returns are tied to. It's basically the risk you expose your assets to.
And do you feel that the index is probably the most cautious part instead of going out on your own or saying, hey, this EV stock kind of tanked today, why not put some money into it?
Yeah.
Should we diversify some in that, or just say, you know what, the S&P, these index, they've given you 10+%, just stick with what you know?
Well, let's see. So I think the beginning of your question had to do with the risk of them, right?
Yeah.
So risk can be quantified with basically the variability of the return of that investment over some reasonably long period of time.
Mm-hmm.
And if you look at the risk of one stock versus the risk of 500 stocks, it's a little more than double. Okay, so what that means is the ranges of outcomes, both on the negative and the positive side, are twice as much as you would expect from owning 500 stocks. So from that perspective, it's less risky. But here's the key. The expected return of one stock is the same as the expected return of all 500 together. And that's because on average, those 500 stocks earn that 10% a year. And you just don't know. People think they know, but you don't know which stock is going to get 100% return or go bust. Okay.
Mm-hmm.
And so this is a Nobel Prize for Harry Markowitz, that the expected return of one stock and 500 stocks is both 10% a year. But when you buy all 500, you basically double the certainty of getting that return. And they call that the only free lunch in investing, because you've improved your expectation of getting that return by diversifying.
Mm-hmm. Yeah,
Does that make sense?
That does make sense, and that's probably why it's important. It's big news when a stock falls out of the S&P or a company, because now they're not part of that index. I know Tesla goes in and out and in and out. As just one example, and other big companies fall in and out. So is that why it's such a big deal? All of a sudden, they're not available in those big indexes anymore.
Well, it can be a big deal to those individual stocks, but I wouldn't say over the long term. That's a short term, maybe opportunity to kind of gamble on those, but you have to be so careful that price adjusts immediately the information is known to traders. This is a real problem for investors, is they read news and they haven't quite appreciated the fact that by the time they've read it, the price is already adjusted to it. And so you're too late virtually all the time is the way you should at least perceive it. And the probability that you know something that's not already embedded in the stock price is virtually zero.
Yeah.
And so, the goal of most investors is to discover a security that's undervalued or overvalued. If it's undervalued, that means, the market hasn't quite appreciated what you know. Then you should back up the truck and load up on those stocks. And if it's overvalued, you should be selling them and getting them out. But the real problem is, instead of that, all securities are fairly valued all the time. And why is that? Because we have 10 million traders, half of them buyers, half of them sellers, and they're trading 10 billion shares a day. And through this huge processing machine, if you will, of all these, some 40 publicly traded markets all over the world, we arrive at the fair market value of all of these securities virtually all the time. And so you should just give up on this idea of speculating on mispriced securities and just accept them as being the fair price. And instead of having speculation as the reason for your return, think of it as basically capturing the cost of capital of those firms. That's a little bit difficult, but every person who gets capital has some cost, something they have to give up to get that cash, right? And all sellers of securities give up their future return. If I sell you Tesla today, I think, oh, maybe in the next 12 months it's going to make 10%. And so I want a price that pre-compensates me for the probability of getting that 10%. And so that's what investing is about, is it's basically capturing the cost of capital of the seller of whatever security you're buying. But the other way you can think about this is, as you just said, 10% for 95 years now, those large companies have earned it's about 9.8, I think, percent per year for 95 years. That should tell you something. But if you invested in smaller companies, those are riskier, have higher cost of capital. It's more like 12%. And then if you look at value companies, it's also in that 12 to maybe a little excess. And these numbers are all based on indexes. We have indexes for that long a period of time. That's the other reason to use an index, is you have more data about the risks and returns of those stocks that have those characteristics. They're large, they're small, their value, their growth.
Yeah. Now, what do you say about, some of us that have been burned by our brokers because they get, perhaps something on the front, something on the end, they steer you. How does that work? And what are some of the tactics that, I love this little blurb that you have. It's how they have tactics that are cleverly designed to make your broker rich and not you.
Exactly. Well, as in most business transactions, you want to follow the money. Okay. How is somebody else making money off of you? And in the brokerage business, their model is to make money on transactions. Almost in all cases, it's a transactional business, right? And we call that the broker dealer world. There's another classification of investment advice through registered investment advisors. And registered investment advisors have a fiduciary duty while brokers don't. And one's regulated by FINRA, one's regulated by the SEC. But the way you get around that is you work with an advisor who just takes a percentage of your assets, so they're not motivated to get you to trade or get you all emotionally excited about buying or selling and basically creating transactions. The short answer, I hate to say it, but brokers are not the best place for investors because they encourage this trading. And we've now, through all this research that I mentioned to you, we've concluded that the more you trade, the worse off you are, not the better off you are. So
yeah, that's very interesting.
We like to say, why they call them brokers is when they're done with you, you're a broker.
Well, I haven't heard that one, and that's very true. For instance, I remember back in the day, I wanted to spend, X amount of tens of thousands of dollars on gold when it was $100 an ounce.
Sure.
And the guy goes, no. There's a fund out there, or there's something American fund that has gold mines, and that's what you want to do instead of put money on gold, because he got 5% on the front, he got whatever on the back,
right?
And I missed out on gold being $100 an ounce. So that's some of the cleverly designed stuff that they do.
I want to just give you a few seconds. I know we're a little short on time about gold and virtually all commodities. Okay. The value of a company is basically the present value of their future earnings. Gold has no earnings. A Bitcoin has no earnings. All commodities are not profit generating investments. Okay. And so their value just is a speculation based on future supply and demand, which really nobody knows. I mean, this whole thing about 21 million Bitcoins and, the demand's got to go up and blah, blah, blah. But there's really no foundational earnings tied to any of these commodities. I would avoid them like the plague. I've got the data right here. The long-term return of gold is about 4%, which is about the same as inflation, except for gold has this huge volatility of about 18% standard deviation. That's a measure of risk. And so that's one of the things that investors want to try to pay attention to. They want to see how much return they're getting for the risk they're exposing their assets to. And that's a Nobel Prize for this guy named Harry Markowitz. He went back and looked at the returns and basically the variability of return, the uncertainty of return. And when you do that, it gives you a set of investments that have maximized the return given the risk, historically speaking. And if you have a really large sample size, I'd say 30, 40, 50 years, then that gives you a better estimate of what you could anticipate literally every year going forward. And so basically that's the application of statistics to the market. And statistics works as long as these prices are fair, so that there's not opportunities to sort of outsmart the market. And that's basically what we've concluded. And that's all in my book, Index Funds. We call it the 12-step recovery program for active investors, because that's sort of modeled after Gamblers Anonymous. They actually have a brochure about stock market gamblers. And so I just kind of used it as a rough framework for the design of my book and providing this education so that people will not engage in speculation, as you said at the front.
Yeah, so let's talk about that. It's very, I never thought about this, that there are people out there that are day trading and they can't get off the computer.
That's right.
And it's just like, it's almost like playing poker or going to the casino.
It is like, it's not almost, it is the same.
It is the same. So it's just another, it's still, it's money, right? So this is the 10th edition of the 20th anniversary of your book, Index Funds, the 12-step recovery program for active investors. Let's talk a little bit about that and what's in it. How do you even, say, hey, yeah, I'm an addict?
So we actually have a list of things, and this is what actually Gamblers Anonymous does also. I think they have 10 items, 10 things that would give you an indication that maybe you have some level of addiction to gambling. And it's things like, is the first thing you think about in the morning is, where's Tesla stock going to be today? And I should run to my computer and look at the charts from the last 3 days or last 3 hours and try to decide what I should be doing. And are your thoughts consumed with the market? As you mentioned, these day traders, I guarantee you a large percentage of their thinking is dedicated to the next trade. And there is the thrill of the big return and the regret of the loss that is constantly nagging at them. Gamblers Anonymous calls each trade an action. And it's like a hit of adrenaline when they actually make this decision to buy, to sell. This is what is the addiction, like it is for drugs and smoking and alcohol, so many other things. It's basically becomes addictive. And as you said, very few people recognize that as an aspect of investing. But I assure you it is. There's been brain studies where addicts have been shown cocaine, and then they've been shown a way to get rich quick. This is the real issue here. People think they're going to cheat risk and get rich really quick instead of slow. Basically, money comes slowly. It doesn't come fast. And so what that does is lights up the same component, same areas of our brain that are tied to our addictive behaviors. And so my book covers all of these in step one about basically, are you an active investor? And then in the traditional 12 steps, they want to come up with something that will be more important to you than your addiction, right? And so traditionally they come up with some God or some religion that gets you away from your addiction. And what occurred to me is the academics, and in particular, those who won Nobel Prizes for their work on how investing works, should be your investing gods. not just somebody who had a great return last year or the last 3 years or whatever. What you want to see is independent, peer-reviewed, empirical research, and in particular, that research that was so good, a bunch of other academics voted on it to get the Nobel Prize. And that's what my step 2 is about. We list all these various Nobel Prizes that lead to this basically a portfolio of index funds type strategy for investing.
So instead of saying, stop doing this and maybe stop doing the daily trading and things like that, you try to get them in, you change their mindset and say, hey, look, you can still invest, but do it the smart way, do it the proven way. Is that correct?
That's right. I like to think of it as giving them an education, just like any place, anytime you go to school, you might walk into some class with some preconceived notions about a topic, but then as the professor starts laying out the facts for you, you're going, oh, okay. I mean, you might think of it as a doctor or a lawyer, anything like that, where there's a certain expertise to be known. In investing, there is a huge body of research and academic papers that I almost guarantee you very few investors paid any attention to. So I mentioned a couple of Nobel Prizes for you. Some of them have to do with this risk and return. The other Nobel Prize I talked about with where the prices are fair, and a third Nobel Prize, well, it's actually a component of prices being fair, but small companies have done better than large and values done better than growth. There's a lot of Nobel Prizes I've been throwing around here that people basically aren't aware of. And once they know these ideas have that sort of Nobel seal on them, then maybe they'll pay a little more attention to them, as opposed to their broker who probably didn't even graduate from college. I hate to say it. It doesn't take a lot to get a brokerage license. They send you to a review course, and then you take a test, and you're out giving investment advice to people. It's kind of scary.
Yeah, it is scary. Every time I walk into my bank, there's a 20-some-year-old kid say, hey,
Yeah.
let me talk to you about retirement fund 2036 or something like that. And I'm like, no, that's okay.
Well, if you need some help, Mike, you can call me.
There you go. I appreciate it. Everybody, we're talking about the book Index Funds, the 12-Step Recovery Program for Active Investors, and Mark Hebner. So what do you see, Mark? We're in an election year.
Yep.
And the stocks always respond usually, this time of year. Are people going to be relieved, or do you still see some volatility? What do you see 2024 and then maybe the end of 2024, 2025? What are your thoughts?
So listen carefully. Nobody knows, including
Good
me.
answer.
Okay?
Good answer.
Stocks follow basically a normal bell curve in their monthly returns. And the reason is those forecasts that you just said are all in the minds of the 10 million traders today. They're all thinking about that. And as they go to place their trades, they embed their knowledge, the current surveys and the polls of all the experts or whatever, all the things that they know. One group of people think that's a buy, another group of people think it's a sell, and they kind of go almost negotiate to get to just the fair price given all that information. So, it's kind of interesting when you look back over time, the returns of the market are almost precisely the same for Democrats as they are for Republicans. And I know both sides might like to say, hey, the market's going to do better under this or that. But just like I told you before, this news and information gets embedded in the price so quickly, it's too late for you to benefit based on your idea or your forecast.
Yeah.
We used to joke that people would read the Wall Street Journal as if they were the only ones reading it. And then they would go and place their trades. First of all, by the time it's get printed in the Wall Street Journal, it's really old. It's the Bloomberg terminal, and that's why Michael Bloomberg is so wealthy, that scrolls that news for the whole world through all these Bloomberg terminals all at the same second. And even there, half the people think it's a buy and half of them think it's a sell, and they come together and come up with the fair price. So the answer is, and let me just add, the record of these forecasters are horrible. Who monitors these forecasts of all these people walking across the stage on CNBC? And they ought to introduce that. Okay, what's been your accuracy over the last 100 forecasts? Okay, well, I can tell you it's pretty low. The accuracy needed is 74%, and there is no long-term record, like 100 forecasts or more, that exceeds 74%. Let me explain that really quick, because that 10% return you mentioned, turns out it's only about 3 or 4 days a year that make up that 10%. So a big day is like 2.5%, 3%, right? So let's just say it's 2.5. 4 of those equal your 10% return. So if you weren't invested when those big days came along, then you missed out on your 10%. And this is why it's so difficult to forecast in a way that would allow you to do better than just buying and holding. That is sort of the benchmark, if you will. The buy and hold index of a similar risk. And all speculators should hold themselves accountable to that, but they don't.
Yeah, that's fascinating, hearing it that way, because it's the same thing in real estate. By the time it gets to an MLS or a listing,
right,
no one else wants it, because all the big guys turned it down, and now that you get to see it.
Yeah, I mean, they're the whole pocket listing, right? They get, there's phone calls made before it even gets in there, and they put it on there for, we might call the newbies, right?
Exactly. That's exactly it.
New. They
must be new. Let's give it a shot. Mark, it's been a pleasure having you on. Where can people find you? What's the websites, LinkedIn?
So the website's IFA.com. That's IndiaFrankAlpha.com. It stands for Index Fund Advisors. And all of our information is there. We have incredible charts and videos and articles that we're considered one of the top resources for investing, I would say, in the world, for what I'll call proper investing, not speculation. And hopefully your listeners will be sobered up by this information, so they don't want to continue to gamble in the market like they are probably doing now. I guess you have a lot of tech listeners, I think you might have said. So, those people like to maybe gamble within their industry, but I can assure you, even though they work in those companies, all the analysts and all the other people that are trading those securities combined are going to know more than you. So let it go. So we have a little questionnaire. So what do you do with your investment? You take this questionnaire to find out how much risk is right for you. And then there's a portfolio of index funds that we show on our website that we can now show historic data for 95 years because they're indexes. And so that's and that's all spelled out in my 12 steps too in my book. There's also an audio book, which is kind of nice. I know a lot of tech listeners are probably more into an audio book, just like they might be listening to this podcast, right? And those with a Kindle or any device pretty much can do a Kindle. You can also get that. So.
Yeah. Well, there you go. Well, thank you, Mark. And again, everybody, it is Mark Hebner, IFA.com. His book, go to Amazon, and it's the index funds, the 12-step recovery program for active investors. Mark, it's been a pleasure having you on the Richer Geek Podcast. Have a wonderful day.
Yeah. You're doing good work there, Mike. Thank you.
Thank you.